If you are within 5 to 10 years of retirement, market pullbacks can feel different. When you are 30, a down market is mostly noise, but when you're 55, 58, or 62, it can feel a bit personal. Because now the question is not just, will the market recover? The question is, how does what's going on right now affect my timeline, my income, and my ability to make work optional? That is exactly why I would like to record this today with what's going on geopolitically right now. We've seen a real pullback this month. The S&P is down a little over 4%, and the NASDAQ is down a little over 3%. And this volatility has been tied in large part to the Iran conflict. And this is also exactly where real strategy matters. Because in moments like this, the people who feel the most stress are usually the ones who have a portfolio but not structure. Welcome back to New Horizons Boutique Financial Services. Today I'd like to talk about this recent market pullback, how our 5-asset segment strategy is built for environments like this, and how you can think about applying the same criteria in your own planning. Because a lot of people today say they have a long-term plan, but when volatility shows up, that is when you find out whether the plan was real or whether it was a good story during an up market. And let's be honest about who this matters most for. If you're a high earner or a pre-retiree with money spread across multiple accounts, IRA, brokerage, maybe some stock options or cash, this kind of pullback creates a very special kind of anxiety. Not because you think the market will never recover, but because you start wondering, do I still get to retire when I wanted to? Do I need to delay a transition? Am I taking too much risk this close to retirement or taking a step back? Do I have enough in the right places to avoid selling growth assets at the wrong time? Is my company stock down? That is the real issue. It's not just your average annual return, it's the structure of how your investments are set up. So what is happening right now? The market weakness we're seeing right now has been driven by a real headline risk. Right, both Reuters and AP have both reported that this month's sell-off has been tied to the ongoing Iran conflict, a surge in oil prices, inflation concerns, and reduced expectations for Fed rate cuts. Reuters said the S&P has fallen by over 4% year to date. Go back, please, to that long one. Reuters and AP have both reported that this month's sell-off has been tied to the ongoing Iran conflict, a surge in oil prices, inflation concerns, and reduced expectation for Fed rate cuts. The S&P has fallen nearly 4% since the conflict began and just over 4% this month alone, while oil has also surged in the meantime. So yes, the headlines are having a real effect this time. But this is the point I would like to make an important insight. For the right investor, market pullbacks are not always the biggest risk. The bigger risk is being forced into bad decisions because your money was not segmented properly to begin with. At our firm, we use a 5-segment framework because not every dollar should be asked to do the same job at the same time. We like to describe this framework for short and long-term needs as a part of the investing strategy and onboarding process, and that's a part many people miss. They look at one total portfolio value and assume all of it should be invested in the same way. That is usually a mistake. A 57-year-old planning to retire in 3 to 7 years should not think about every dollar as long-term growth money. Some dollars need stability, some liquidity, some need to be available today, some need to stay invested for much longer. Some should be positioned to capture longer-term upside as well. That is the value of segmentation. Now your exact labels may differ, but here is a very workable version of our 5-segment concept. First, immediate liquidity. This is your most stable money. Cash, high-yield cash alternatives, or very short-term reserves. This is money meant for near-term needs, emergencies, and peace of mind. Its job is not high return. Its job is to keep you from becoming a forced seller. The second piece is short-term stability. This is money for the next 1 to 3 years. Think conservative positioning designed to help you cover known needs or give you a bridge during volatility. Again, this money is not trying to win performance contests. It's there to support the plan when markets get noisy. The third piece is the intermediate. This is money over the next 3 to 7 years. It can usually take some measured risk, but not the same level as fully long-term growth assets. This segment helps create a middle ground between safety and growth. The fourth segment, we're getting into long-term growth. This is money you don't need soon. This segment can stay focused on long-term market participation. This is often where equities and broader growth exposure play a bigger role. The fifth segment is more of that aggressive growth or opportunistic capital. This is the money with the longest time horizon. It may be positioned for higher growth potential, thematic opportunities, or assets that need time to work. This money only belongs here if your household already has the first four segments doing their job. And here's why it matters in a pullback and right now. When the market pulls back, someone with no segmentation often feels like all of their money is under attack all at once. This leads to emotional decision making. But if your first 1 to 3 years of needs are not dependent on selling your down growth assets today, you have more time to breathe, and that helps change your behavior, your confidence, and often it changes your outcomes. Because the goal in volatile markets is not to outguess every headline, it's to avoid being forced into bad timing. Here's why our process is a bit different when it comes to investment management. Not everything is in isolation. During this time, as we got up to market all-time highs, we took some strategic peeling off of that fifth asset segment, which has done a really great job over the last year or so. What we have then done is used and implemented our system to then buy back as the market has corrected here. Because we had both the conservative segments and the aggressive segments, we were positioned for this pullback, but also able to take advantage to it. So here's a simple way of implementing this yourself. Stop viewing your portfolio as one giant number. Start grouping your assets by job, not just by account statement. What money do I need soon is something you should ask yourself, as well as what I need later, what needs stability, and what can stay invested through volatility. The second step is to match each segment to a time horizon. A great way to think about it is segment 1 is now over the next 12 months, the next one 1 to 3 years, 3 to 7 years, 7 to 12, or 12 plus years. Now this exact timeline can vary, but the key is that time horizon should shape the investment role. The third piece is you should tie those segments to real life. Don't build them in a vacuum. Tie them to actual needs. So tie them to your retirement date, your income gap before Social Security, travel goals, home projects, healthcare, helping kids get launched or aging parents, job transition flexibility. That's when the plan comes real. And the fourth step is knowing which bucket protects you in the down markets. Now, this is the biggest part. You should be able to answer, if markets stay messy for the next 6 to 12 months, where does my cash flow come from? If you do not know the answer to that question, your plan may be too dependent on market cooperation. So the fifth step, building off of that, is rebalance with purpose, not a panic. Pullbacks often create the need to review, rebalance, and recheck positioning. That is very different from reacting emotionally. Now, reviewing is healthy, repositioning can be smart, but panicking is expensive. Marketing for affluents, the real appeal here, back up, there. For affluent pre-retirees, the real appeal here is not beating the market. It is this: having enough structure in place that a market pullback does not automatically threaten your lifestyle, your timeline, or your sleep. You would like to know, can I make work optional? Can I still protect the life I have built? Can I still move forward without feeling like one bad quarter changes everything? The big piece here is, if we double your money today, how would that change your life? Now, if we cut your money in half, would that change your life more or less? So if you're watching this during this time of a pullback, this pullback is not just a taste of a pullback, it's a test of the structure of your portfolio. If your money has been segmented properly, volatile periods become easier to navigate. And that's not because it's fun, it's because your plan is not asking every dollar to do the same job at the same time. And if your portfolio is still just one large pile of money without clear roles, this may be the perfect time to fix that. If you're within 5 to 10 years of retirement and would like help pressure testing your current allocation, please visit our website and schedule a conversation. And finally, please subscribe if you would like more videos on retirement income, tax-aware planning, and smarter ways to handle market volatility. Thank you and have a great day.